All right, Chris Hallows here with the Hallows team, and I'm sitting here with Kai Degomez as a local certified public accountant. And as a lot of you guys have been seeing and hearing stories about the tax bill, and I'm sure seeing clickbait out there and all sorts of scary headlines about home buying, and is it really now not a great idea because of the tax bill? So I want to come and sit down with a local professional, and as a full disclaimer, we'll talk about some scenarios, some ideas, and but really advise you to call Kai. His information will be at the end of the video, and talk with the local certified public accountant about your specific scenarios. Talk with me about the mortgage and how that really plays into your bigger plan for specific advice. But let's dive into it, Kai.
I think the big people that are going to be disadvantaged are the people that have mortgages over $750,000.
Okay.
So in the past, they've been able to deduct up to $1.1 million of mortgage interest. Now it's going to be $750,000. So if you're a home buyer, if you're thinking about buying a house, have a mortgage over $750,000, definitely going to be disadvantaged with this tax law.
Gotcha. So you won't be able to deduct as much interest as you used to. Okay. Right now, just so you guys know, average sales price in Flagstaff is about $307,000. So studies right now show about 2% of people is who you're talking about roughly. Mm-hmm. So if you have a mortgage up to there, you're doing pretty good.
Right,
so yeah, but now disadvantaged. Okay. Mm-hmm. So let's talk below that. So let's talk about then your move-up buyer kind of in Flagstaff. So with that 307 sales price, let's talk about 450-ish to 750. Mm-hmm. Is that move-up buyer disadvantage?
So that move-up buyer, they are probably, depending on their own situation, the standard deduction in the past in 2017 was $12,700.
Yeah.
That increased to $24,000, and so most people in that 450 to 750 mortgage bracket, they will probably still itemize. So they're probably still getting a benefit, a tax benefit for having that mortgage.
Okay, gotcha. So because of the expense on their mortgage,
Mm-hmm.
they'll still be able to take advantage. Whereas if they rented, they wouldn't have that advantage. They'd be using a standard. And gotcha. Okay. So more around that average. So more of that first-time home buyer. Yeah. So let's talk. 450 below. Are they disadvantaged?
They're. I wouldn't say they're disadvantaged. They're not going to be able to itemize most likely unless they have real high charitable deductions. So the average buyer who's buying a $307,000 house, putting some money down, when we add up their mortgage interest and their property taxes that are additional deductions, they're probably not going to get up to that $24,000 limit. So there's no longer a benefit, but I wouldn't say they're disadvantaged. Hopefully, the average American is going to save taxes by this tax bill, and then they'll have a little more discretionary income, and so they should be able to hopefully purchase that home, because I still think owning a home is a great investment. Most people in retirement, their biggest asset is their home or their retirement account, and so still a great idea.
So awesome. And so then one question then is, I heard some things being thrown out around capital gains, because we all know if you sell a house, it's considered, and any gains you have from that house can be considered a capital gains in tax. There was some talk about them lengthening the term that you had to live in a home to then have that non-tax. Did they end up doing that or no?
No, they didn't. No, they didn't. They kept capital gains rates the same, and then if you've lived in your home for 2 of the last 5 years, it's been your primary residence, you don't have to pay gain. $250 if you're single, $500 if you're married, filing joint. So those have stayed the same. They talked about increasing. You had to live in it 5 of the last 8 years. So now it's just still 2 of the last 5 years. So it's a great deal. So if you're thinking about selling your house, you're like, I've made quite a bit of money, only owned it for maybe like 4 years, you still are in a good position. As long as it's been your primary residence, you have the $250 to $500 depending on your filing status of gain exclusion. So great deal.
Awesome. So that, especially for the move up. So I'm seeing, especially that move up buyer, based on price point and based on capital gains not changing at all, they're still advantaged. Still good opportunities there.
Yep.
And the last point, you had a bonus tip for investors, something that we didn't have in 2017.
So the one big advantage to real estate investors is there's the potential for a 20% deduction against your income, just a straight deduction. And so It varies on how long you've owned the property, how much the property was purchased for, but it's a great deal. If you're a real estate investor, your properties are generating income, there's a really good chance you're going to be eligible for this 20% deduction. So it's actually a great benefit to real estate investors, which is kind of interesting based on who's running the country, but it's definitely real estate investors.
Gotcha. So good things for people who want to own property.
Yeah.
Cool.
Sounds good.
All right. Well, thanks, guys. Thanks for watching. We have Kai's number here below, and if you have any questions, call him directly. Always looking to help you with the local boys here.
Sounds good.
All right.